Treasury inflation-protected securities, otherwise known as TIPS, will be one of the best investments for 2023. They offer a hedge against inflation, and they are backed by the full faith and credit of the United States government, so there is no credit risk. They are not subject to state or local taxes, and in addition to biannual interest payments, they have a large potential for capital gains. You can buy directly from the government or from brokers. Treasuries are a type of bond issued by the U.S. government to finance its debt. There are several types of treasuries. This video focuses on Treasury inflation-protected securities, otherwise known as TIPS. Treasury bills are also a good investment. Check out my video on Treasury bills. The link is provided in the description below. As a hedge against inflation, the principal of TIPS is adjusted every 6 months, right before the semi-annual interest payment, based on the Consumer Price Index. TIPS are issued only in electronic format, with maturity terms of 5, 10, or 30 years. Interest is paid every 6 months. The interest amount is determined by the principal, adjusted for inflation, multiplied by the interest rate, which is fixed for the life of the bond. At maturity, the greater of the adjusted principal or the original par value is paid. TIPS are not subject to state or local income taxes, but they are subject to annual federal taxes on both the semi-annual coupon payments and the adjustments to principal. The tax and adjustments to principal is often referred to as phantom income because you must pay the tax annually even though the principal adjustments are not received until the security is sold or matures. Therefore, it is best to hold TIPS in tax-advantaged retirement accounts. You should receive Form 1099 OID from your custodian, showing the amount of interest paid in Box 2 and adjustments to principal in Box 8. Although it is not necessary, some custodians may choose to report the annual payment of interest separately. If interest payments are not reported on Form 1099 OID, then the interest income is reported on Form 1099 INT in Box 3. To see how this all works out, consider this example of a 5-year TIPS with initial investment of $1,000, a coupon rate of 1.5%, and a constant inflation rate of 3.0% annually over 5 years. The amount taxable each year increases with the increased adjustment to principal and the increased interest paid because of the higher principal. This shows the total payments and final principal that you would receive. You can add the coupon rate to the inflation rate to get an approximate value of the annual increase in your return. As you can see here, the total return is slightly less than the coupon rate plus inflation rate, compounded annually for 5 years. There are 2 types of bidding, competitive bidding and non-competitive bidding. Most people use non-competitive bidding, but all successful bidders get the same rate, yield, or discount margin as the highest accepted bid. Most people and organizations can bid for treasuries. At TreasuryDirect, the minimum bid is $100. Higher bids must be in multiples of $100. TreasuryDirect only allows non-competitive bidding. At most brokers, the minimum bid is $1,000. Higher bids must be in multiples of $100,000. This is the auction schedule for Treasury inflation-protected securities, showing the auctions for original issues and for reopenings. Reopenings are simply another sale of a previously issued security, having the same maturity date and coupon interest rate as the original issue, but with a different issue date and purchase price. Unlike other treasuries and most other bonds, TIPS ensure the payment of a real yield, a yield that more than compensates for inflation. If the inflation rate exceeds the nominal interest rate, then the real yield is negative. In other words, the purchasing power of the investment return is declining. The fixed interest rate is determined by auction. Auctions even allow negative real yield bids, but if the bid yield is less than 0.125%, then the yield is set to 0.125%. If the bid yield exceeds the minimum, then the interest rate is adjusted downward to the highest multiple of 0.125%, or 1/8 of 1%. The price is adjusted accordingly. Although the minimum yield of 1/8 of 1% is extremely low, the principal adjustments can be significant during times of high inflation. The interest rate represents a real return, in contrast to the nominal inflated return offered by other bonds. To compare the yields of TIPS to treasuries, you must consider the inflation rate plus the real yield. The nominal yield of most bonds and other treasuries consists of a real yield plus a portion of the yield that compensates for inflation. The total return of TIPS equals the coupon interest rate plus the principal adjustment according to inflation. The break-even inflation rate is the rate of inflation that equalizes the total return of TIPS with other treasuries or other bonds with coupons paying a nominal yield. From 2009 to 2022, the break-even inflation rates ranged from 1% to 3%. The official method for calculating adjustments to principal is not too complicated, but if you want to learn the details, you can go to this website. The adjustments to principal depend on the index rate. equal to the CPI of the applicable date over the CPI at the dated date, which for originally issued TIPS is always on the 15th of the month of settlement. The adjusted principal equals the par value multiplied by the index rate. The interest equals the adjusted principal on the day prior to the payment of interest multiplied by the interest rate. The adjusted principal at maturity will equal the par value multiplied by the index rate for the date of maturity. All TIPS are auctioned on the next to last Thursday of the auction month. The announcement for the auction is on the prior Thursday. Therefore, investors who purchase TIPS at auction must pay the interest and the principal accrued between the 15th of the month and the issue date. After you pay for the accrued interest plus the principal adjustment, then you will receive the accrued interest from your first interest payment, but you will not receive the paid principal adjustment until the security is sold or matures. The dated date is an important date because it is the start of the first 6-month period earning interest, and because the CPI for this date serves as the base reference CPI for determining all principal adjustments. You can buy TIPS either at TreasuryDirect or through your broker. When buying TIPS at TreasuryDirect, you can only buy new issues through auctions. To buy at TreasuryDirect, click on the Buy Direct tab. Select TIPS. Then click Submit. Then you are presented with the 3 options of available terms. Unlike buying at a broker, you can schedule the purchase of TIPS before the announcement for those securities. You can also buy TIPS at brokers, not only new issues through auctions, but also already issued securities in the secondary marketplace. You can also buy TIPS for your retirement account. However, the minimum purchase is usually $1,000, and the purchases must be in multiples of $1,000. Brokers only display newly issued treasuries that have been announced. For TIPS, the announcement is the Thursday 1 week before the auction, which takes place in the second to last Thursday of the month. Thus, newly issued TIPS will only be available at brokers for 1 week per month, since there is only 1 week between the announcement and the auction. Remember, in any given month, only TIPS with a specific term, 5, 10, or 30 years, will be available. So if you want to buy from your broker, set a calendar alert for the type of TIPS you want. To illustrate, these are the 4 treasuries that were available on December 17, 2022. Notice that only one of these are TIPS. This is why you need to set calendar alerts. The listing of TIPS in the secondary marketplace displays not only prices and the accrued principal, but also the yield to maturity, otherwise known as the true yield. If you buy a bond in the secondary marketplace and pay a price different from par value, then there will be a gain or loss when the bond matures, when you receive the par value of the bond. Yield to maturity incorporates this gain or loss. The formula for yield to maturity is rather complicated, but it is easier to understand how the market price affects the yield to maturity. If you pay less than par value, then the yield to maturity will exceed the nominal yield because you will have an additional gain on the principal. If you pay more, then the yield to maturity will be less than the nominal yield because you will have a loss on the principal. In most cases, you will buy a bond in between interest payments, which means you must pay accrued interest to the seller of the bond. The accrued interest steadily increases until the interest is paid, then it drops to 0. Then it starts increasing again. You must also pay for the adjusted principal. Prices in the secondary market do not reflect accrued interest, but the listings do list the accrued principal. A peculiarity of Treasury prices listed in the secondary market is that price quotes are in increments of 1/32 rather than pennies. This is a tradition held over from the times when brokers quoted most security prices in fractions rather than in dollars and cents. It benefits market makers by keeping the bid-ask spread wider apart. TIPS are subject to interest rate risk, which is more pronounced when coupon rates are low and terms are long, which are both qualities of TIPS. This is the primary reason why prices can decline even when inflation is high. TIPS declined 13% in 2022, while Treasuries declined 14%. So even with the Consumer Price Index equaling 8.2% in the 12 months ending September 31st, 2022, the price decline exceeded the positive principal adjustment. The primary benefit of higher interest rates is that coupon rates also increase for newly issued TIPS. TIPS purchased previous to interest rate increases will decline in price, as has been the case for most of 2022. Brokers differ in the way that they list TIPS. Too many ways to present here, so I will show how TIPS are displayed on TD Ameritrade to give you an idea in how they are presented. On TD Ameritrade, the secondary listing for TIPS shows the maximum and minimum quantities available, along with the price and the yield to maturity. At the bottom of the screen, you see the total principal and accrued interest and total cost. With most bond listings, you also see a yield to worst. The yield to worst is the bond yield if the bond is retired at the earliest possible date allowed by the bond's indenture, such as if it were called at the earliest allowable date. However, since Treasuries cannot be retired before maturity, yield to worst for all Treasuries equals the yield to maturity. On TD Ameritrade, this was the list of tips that were available. We will now look at the bottom security in more detail by clicking on the plus sign next to the buy link. Notice that the top row is shaded in green. This is the lowest price available, but the minimum quantity is 50. The lowest quantity on the screen is 5, so you cannot buy less than that for this security at this time. But to buy only 5, you must pay a higher price. By changing the order quantity to 10, the third row is shaded green, since a higher price must be paid to order just 10 securities. Note that, even though I am paying only 68.4% of face value, the amount of principal exceeds $7,300 because there is some accrued to principal. Adding that to the accrued interest yields the total cost. Clicking on the Buy button yields the details for one security. Click the Calculate Total Cost button to calculate the total cost. Most interest earned from bonds is subject to federal, state, or local income taxes. However, TIPS, as federal securities, are not subject to state or local income taxes. Therefore, to compare TIPS to other investments that are subject to state or local taxes, you must calculate the taxable equivalent yield, equal to the TIPS yield divided by the difference of state and local tax rates subtracted from 100%. You can also buy exchange-traded funds and mutual funds holding TIPS. The yield for a fund is adjusted monthly based on the inflation rate. One benefit of mutual funds is that they pay investors both the interest and the principal adjustment monthly. A drawback of mutual funds is that the inflation hedge may be less because fund managers may buy or sell TIPS before maturity. However, fund fees will slightly lower the return to funds compared to the underlying TIPS. TIPS are comparable to I savings bonds. Both use the same CPI index for inflation adjustments. Both securities are exempt from state and local income taxes. Both are guaranteed by the U.S. government. The advantages of I-bonds over TIPS is that I-bonds have no interest rate risk, since redemptions are paid at face value by the U.S. government. Federal taxes do not have to be paid until redemption or maturity. Federal taxes can be reduced or avoided by paying for qualified educational expenses. Interest is earned from the beginning of the month of purchase, even if the actual purchase occurs at the end of the month. The disadvantages of I-bonds are that the minimum holding period is 1 year, and the last 3 months of interest are forfeited if redeemed before 5 years. I-bonds cannot be sold in the secondary market. I-bonds can only be held in TreasuryDirect accounts, so they cannot be purchased for retirement accounts. Purchases are limited per calendar year to $10,000 per individual or per entity, although an additional $5,000 of paper I-bonds can be bought per individual tax return, but only by using your tax refund to pay for the purchase. As of December 2022, interest rates are near a maximum, but they will probably rise a little more in 2023. Ordinarily, you should wait until interest rates are highest before buying treasuries, because increases in the interest rate will lower prices in the secondary market. However, with TIPS, there is another consideration. The Federal Reserve is increasing interest rates to subdue inflation. Although you can wait until interest rates peak, you will lose the adjustments to principal that are occurring because of the higher inflation rate. If you intend to hold to maturity, then now would be the best time to buy. If you plan to sell before maturity, you may still be better off buying now. The increases in principal should help to compensate for lower prices in the market because of higher interest rates. The Federal Reserve may also lower interest rates in a year or so, especially if a recession occurs, as many economists predict, so you may even be able to sell at a capital gain.
Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.